This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading major trend reversal bottoms. I think it's important to understand that sometimes you'll get a weak setup, a setup that does not look particularly good, yet it can lead to a major reversal. Other times you can get a very strong looking setup and it will not lead to a reversal. And then I want to talk a little bit about taking profits. You always have to have a plan to take profits, otherwise they will disappear. This is the euro versus the dollar, a daily chart, and we're in a bear trend. We have a very tight bear channel and a break above the bear channel and a break above the moving average, and it rallied about 10 bars. And we have a bar here completely above the moving average. Its low is above the moving average. There's a gap. And usually when you get a gap bar, it leads to the final leg of the bear trend before the market attempts to make a major trend reversal. This rally is strong enough for traders to begin to look for a major trend reversal after the next resumption of the bear trend. However, we have a very tight bear channel here. This is a very low probability buy. Most traders would not take that buy. The bear trend resumed again, and again a very tight bear channel. Most traders would not take this buy or that buy either. Whenever the bear trend resumes and it goes on for about 30 or more bars, the bears have regained control, and usually you need a new trend line break and you have to start the process over again, looking for a break above the trend line, a resumption of the bear trend, and then a reversal. Can you buy this? This is not a very high probability buy. We have a break above the bear channel here, but then the bear trend resumed for a lot of bars, and a lot of traders would need another break above the bear channel before looking to buy. However, some traders might take a chance that this is a major trend reversal from this trend line break. There's a 2-bar reversal, down and up, a bar closing on its high. Some dojis here, so some loss of momentum on the part of the bears. Low probability buy for a major reversal. It's probably a minor reversal, but it's certainly worth taking a chance. We have a small break of a bear channel, only 5 doji bars, so not much buying pressure. Every one of these tails means the market sold off, reversed up, sold off, reversed up. There's some buying pressure, but again, when we get the break below that final flag, we're probably going to get a trading range and not a bull trend. Is this a lower low major trend reversal from this bear trend? No, it's not a major reversal. It's probably a minor reversal. Is it a major reversal from this bear trend? Probably not. The trend resumed again, and I think traders have to be looking at this as the bear trend. And we do not yet have a major reversal. But sometimes a minor reversal can lead to a bull trend. Whenever there's a reversal up after a pretty tight bear channel, the reversal up is usually minor, in which case the bear trend resumes. And a lot of times you need to get a double bottom before you get a rally. Here we have a small double bottom, and this is a bigger double bottom. Now, this is interesting. This is really not a good lower low major trend reversal, but we have about 10 bars up with several pretty good bull bars here, here, and here. And therefore, traders will again begin to look for a major trend reversal. Gap bars again often leads to the final leg of the bear trend before there's a major reversal. While this is not a very good lower low major trend reversal, this might be an acceptable higher low major trend reversal. Gap bar, break above the bear channel, pretty good buying pressure, and decent buying pressure earlier and again here. The bulls are starting to get some control over the market. We have a small double bottom here, a bigger double bottom here, and a higher low major trend reversal. When you take those reversals, the probability of a swing up is only 40%, but the potential reward is much greater than the risk, and therefore they are good setups. There are different ways to look at this. We got 3 pushes down, 1 reversal, 2 reversal, 3 reversal, and we have 3 pushes down here, 1 pullback, 2 pullback, 3, and then again here, 1, then up, 2, then up, 3, then up, and therefore it's a nested wedge. I don't think of it as a lower low major trend reversal, either from this bear trend and this final flag, or from this bear trend and this final flag. I think of it more as a wedge bottom, but even as a wedge bottom, it's not particularly good because the channel is very tight, and usually a tight channel leads to a minor reversal and a trading range, and not an opposite trend. Once you get the minor reversal and the trading range, then you can look for a higher low major trend reversal and a swing up. Most of the traders taking these buys are looking for scalps. 10-bar rally above the moving average, and we have gap bars here, usually leads to the final leg down before an attempt at a major trend reversal. We had that here. We have a gap bar, and we have a final leg and an attempt at a major trend reversal, but it failed. Not a very good looking buy. This, on the other hand, is a better looking buy after this gap bar. If you want, you can call it a small triangle. We have 3 reversals down, 1, 2, 3. You can also call it a bigger triangle, including all of these bars if you'd like. Here's a larger triangle, 3 pushes up, 1, 2, and then try to go up here, 3 pushes down, 1, 2, 3. As soon as you see 3 pushes down or up, and the market's pretty much sideways and converging, it's a triangle, even though it usually does not look like a triangle. The market's in breakout mode. Reasonable to take this buy. We're above the moving average. We have a first entry, a second attempt, and now we have a bull reversal and a pullback. Here's a third attempt to buy. It's a reasonable higher low major trend reversal. We started with a minor reversal here. We got a break above the trend line and a break above the moving average, and now this has a better chance of being a major reversal. Here we have a bottom that's not particularly strong, a very tight bear channel, but it became the low of a bull trend. This is still a minor reversal, and it led to enough buying pressure so that the bulls had a reasonable chance at a major reversal. Can you call this a major reversal? It led to a bull trend. I think of this more as a minor reversal and then a trading range, and then within the trading range, the bulls got a major reversal. Low probability for a major reversal based upon the wedge or from the lower low major trend reversal. However, this minor reversal ended up being the low of the entire bull trend. Most traders taking this buy would scalp, and then traders taking this buy would think about considering a swing trade. If you want, you can also look at this as a wedge bear flag. 3 pushes down, 1, 2, 3. Does not matter that this low is below that low. It's still part of the wedge bear flag. Markets transition from bear trends to bull trends, and there are times when there are elements of both the bull trend and the bear trend coexisting. The bear trend ended here, but this rally began here before the bear trend ended. There's an overlap of the bearishness and the bullishness. I said buy a lower low major trend reversal. I think this is more a minor reversal. It turned out to be the low of the bull trend, and I have it labeled as a major trend reversal, but it's really not. It's probably more a minor reversal. This, I think, has a better chance of being a major reversal. This probably was going to lead to a bear flag or a trading range. Once you get the trading range, then you can look for a major reversal. So I think of these buys as entries for a major trend reversal. 40% chance you get a swing up, and the reward much bigger than the risk. And that offsets the low probability. Some traders worry about, I got to take the exact right entry. If I don't take this, I missed the whole trade. I can't take any of this. And that's wrong. If you look at the volume of any of these bars, you can't really see volume in a Forex market, but some brokers will allow you to see volume. If you look at the futures equivalent of this, you'll see that there's good volume on every bar. And that tells you that institutions have reasons to buy and reasons to sell at every minute. And therefore, you can find those reasons and you can enter as well at any time. You don't have to catch the absolute low. You don't have to catch the beginning of the higher low major trend reversal. There are reasons to buy all the way up. As long as you're willing to hold for a reward that is at least twice your actual risk, then the strategy is profitable. Whenever you enter, there's always a trade-off between probability and risk-reward. If a trade has really good risk-reward, buying here has very little risk, it usually has low probability. In other words, the probability of a swing up is small. If you buy here, the stop is further away, but the probability of making money is much greater. So the risk-reward is worse here. There's greater risk and there's less profit remaining, but the probability of making money is greater. Traders can buy for any reason all the way up. Here they can buy closes. We have a breakout bar and a bull follow-through bar. They can buy below the low of this bar, betting the bear reversal will fail. They can buy below the low of this inside bar, again betting the bear reversal will fail. You can buy above the high of this inside bar. It's a high one bull flag, betting the bull trend will resume. We have a small triangle, 3 pushes down, 1, 2, 3. You can buy above that high. And then we have a little breakout and then a two-legged pullback. You can buy above this high. A very strong breakout, you can buy closes, or you can buy above the high of that one bar bear reversal attempt. It's a high one bull flag. And then you can buy closes all the way up. Here we have a pullback to the moving average, a 20 gap bar buy. You can buy at the moving average with a limit order. You can buy at the low of this bear bar, betting that the bear reversal will fail and that the bull trend will resume. Here you have a double bottom. You can buy above that bar. You got a breakout and then a pullback. You can buy above the high of this bar and get long here. And here we have a pullback again to the moving average, another double bottom. You can buy on the reversal up or above that bull bar. Here's a small breakout and a pullback. You can buy above the high of this pullback, betting that we'll get at least a bar or two higher. It doesn't matter which entry you take. There's a reason to enter on almost every bar. And the same is true with the bear trend. There are reasons to sell on almost every bar. When the market looks like this, you should only be looking to sell. When the market looks like this, you should only be looking to buy. Good buying pressure, consecutive bull bars, another bull bar, and then we have 4 bull bars here, 2 bull bars here. A lot of bull bars closing near their highs, a break above the trend line, and moving average gap bar here. This is the necessary collection of ingredients for a major trend reversal on the next test down. Moving average gap bar, gap between the low of that bar and the moving average. It's a sign of strength. The bulls were strong enough to put a bar completely above the moving average. Not a very good looking higher low major trend reversal. You can argue it's a double bottom higher low and therefore higher probability, but a 5 bar bear microchannel, a very strong bear bar, no strong buy signal bar. This is probably going to be a minor reversal and not the beginning of a bull trend. I usually would not take that buy. I would wait for a second entry buy when the bear channel is that tight. Had you taken that buy, your stop would have been either here or here, and you would have been stopped out for a small loss. 60% of the time, if you take a reasonable major trend reversal trade, you're either going to make a small profit or a small loss. 40% of the time, you can make a very big profit, and that makes the strategy worthwhile. Whenever a trader is stopped out, you should always consider the possibility that the bear breakout and trend resumption will fail. Usually when you get stopped out, you should assume there's a 50% chance the break below the stop will lead to a swing down, 50% chance it'll soon reverse back up. If you're looking for a bottom and the bear trend resumes, be prepared to look for another bottom. Strong enough bear breakout, probably going to get a second leg down. So first leg down and then second leg down. And traders will look to buy a reversal up. Same here. Here's a first entry buy, a high one, and then we have a small double bottom. Buying above that bar or above this bull bar would be a second entry buy. I think whenever you're taking a trade, it's very important to have a plan to take profits. If you do not take profits, you'll discover that they soon disappear. Again, the euro versus the dollar, a daily chart. Let's say you bought this high or low major trend reversal. The minimum profit that you need to make the trader's equation positive is 2 times your actual risk. You only know what your actual risk is once the trend starts to go your way. Then you can look back and figure out how much you actually had to risk to not have been stopped out. You always know your initial risk. That's the distance from your entry to your initial stop. The math is always okay to take full profits at 2 times actual risk. And since initial risk is always at least as big as actual risk, it's always okay to take full profits at 2 times your initial risk. Just because taking profits makes sense mathematically at 2 times actual or initial risk does not mean it's the best thing to do. If your actual or initial risk is very small, taking profits at 2 times that risk is going to result in a profit that is far too small given the potential profit that is on the chart in front of you. You have a bear trend this big, the rally might reverse 50%. If it reverses 50%, that is 5 times bigger than your actual or initial risk. And therefore, if your initial risk is small, do not be too quick to take profits, and do not take your profits based upon the actual or initial risk. Or if you do take profits, only take a small portion of your profits, like a quarter to a half of your position. For example, if you buy above the high of this bar, you get filled right there. And at this point, you discover that your actual risk was just to below these bars. So a very small actual risk. Mathematically, it's okay always to take full profits at 2 times your actual risk. Here's your initial risk. Your stop was below the double bottom and your entry price is there. That's how much you were risking initially. Remember, this is a daily chart and this is a 200 pip move. Your initial risk here is more than 100 pips. If you take profits at 2 times your initial risk, you're taking about 200 pips profit. Even though there's still potential to the top of this lower high or even to the top of this lower high, it's reasonable to take a quarter or a half of your position off there. This is a strong enough breakout, so chances are we're going to get at least a small second leg up, and therefore it's probably good not to take your full position off there. When you get a strong breakout like this and you see it approaching your limit order to take profits at 2 times your initial risk, make sure you do not exit completely, because when the momentum is that strong, you're probably going to get some kind of a measured move up, maybe based upon the height of this trading range. Maybe we'll go up to a resistance area, a major lower high here or all the way up here. And you do not want to exit completely when there's still very good profit potential left. For example, we have a trading range and then a breakout and a pullback that's testing that breakout. Maybe this is a measuring gap from this high to that low, and here's a measured move up. That would be another logical place to take profits. When you have a pretty strong breakout like this, chances are you're going to rally for some kind of a measured move, maybe simply based upon this low to that high, maybe this low to that high, maybe this low to that high and to that low. High probability, 60% probability, that you'll get some kind of a measured move, and therefore do not take profits too early. We have another leg up here, and therefore another potential measured move up. We're getting a bull breakout above a top. The bears tried to get a wedge, 1, 2, 3, 4, 5. They tried to get a wedge bear flag. They tried to reverse. Instead, we get a breakout, and therefore you're going to be thinking about a potential measured move up based upon either this low or this low or this low or that low. In any case, you're going to be thinking about a measured move up and, again, looking to take profits around that measured move. Here we're starting to get a parabolic wedge rally. We have 1 push up, pull back, 2 pushes up, pull back, 3, 4 pushes up, and the biggest pair of bull bars in the entire bull trend, probably climactic, and we're probably going to pull back and get a trading range and test the bottom of the buy climax. And therefore, it's reasonable to be looking to take profits somewhere up in this area. An exhaustion gap is more likely than a measuring gap. A gap from this close to the high of the breakout point probably will close. We'll probably get a pullback below that high, and we'll probably test down to the bottom of the buy climax, because that is what usually happens. When you have the strongest breakout occurring 20 or more bars into a bull trend, it's more likely an exhaustion move than it is the start of an even stronger leg up. When you have a strong breakout early in the trend, it's more likely a measuring gap. Everyone's always worried about the perfect way to take profits. They're always worried about the perfect way to enter, the perfect way to manage trades. There's nothing perfect. All you have to do is do things that are sensible. Just look for logical reasons to take profits. The minimum goal is at least 2 times actual risk. If actual risk is small, then at least 2 times initial risk. And if that is small as well, then go for higher. Look for resistance areas, taking profits around a prior lower high, taking profits at a measured move up based upon a breakout above a trading range. Here's a breakout, here's another breakout. First leg up, pull back, second leg up. Reasonable to take profits around here as well. Measuring gap. Rallied, tried to top out, and instead broke to the upside. Whenever you see a breakout, look back to the left for the start of that leg up, and then project up to find a measured move target. We have the height of a trading range. The market tried to top out here, instead broke out to the upside, and therefore take profits a measured move up based upon the height of the trading range. The height of the bodies. We have a very strong bull bar. On the breakout, we're probably going up for a measured move based upon the height of the body. The open of this bar to the close of this bar, there's the measured move projection. The height of a pullback. We have a pullback in a bull trend. Traders will look to take profits around a measured move up. Parabolic buy climax. The strongest breakout late in a bull trend, probably near the end of the move. Traders will take profits either on the close of that very big bull bar or on the reversal down, especially since it's right at a measured move target based upon the height of this lower trading range. And it's getting near the top of another major lower high. Big buy climax, good to take profit on the reversal down, betting that the market will probably go 10 bars, 2 legs sideways to down, 1 pullback 2 or 1 pullback 2. Every trend, no matter how strong, eventually ends and it becomes a trading range. Most bull trends end with some kind of climactic behavior. For example, we have a very tight channel and we're getting a bull breakout above the channel. Most bull breakouts above bull channels fail, and therefore if you see a strong breakout above a bull channel and it starts to reverse, then it's probably going to fail and test down to the most recent bottom of a climactic leg, which is the bottom of these two bull bars, and then probably go sideways. Swing traders, once they have greater than 2 times their initial risk, they have to get out at some point, and they'll either look for a reasonable sell signal. Here we have a lower high major trend reversal or a double top, slightly lower high, reasonable to get out there. Or they'll be looking to get out at important resistance levels. We're just below this high, and this is the start of a very strong sell-off, and therefore it's a resistance level. Traders will be looking to take profits when the market gets near there and starts to reverse down. In general, if you think the market's going to have a deep pullback and the trend has lasted 20, 30, or 40 bars, it's usually better just to exit, because if it's going to have a deep pullback, then you're going to have a big up, big down situation, and that means a trading range. And you have to adjust your style of trading. You're no longer betting on a strong bull trend. Now you're betting on a trading range. And if it's a trading range, it's good to sell high. And if you want, then you can trade it like a trading range, buying low and selling high. A lot of traders never worry about picking an exact bottom or an exact top. They enter when they think the market is in the general area where a reversal will take place, and they use a wide stop and scale in lower. For example, the market tried to bottom here, and instead we got a double top bear flag and then a sell-off. Usually, if you have a double top bear flag, the market will fall to around a measured move target and then reverse. And therefore, once the market started to go back down again, if you're looking for a bottom, a reasonable location for a stop is just below that measured move target. We have a double top neckline, measured move down. Usually there'll be buyers around that measured move if we get there. And therefore, if you buy for any reason, it's reasonable to put your stop just below that target, because you know traders will buy at that target. Bears will take profits and bulls will start to buy. Strong buying pressure, consecutive bull bars, 4 bull bars, 2 pretty good bodies, a very big bull bar, good buying pressure, so the odds favor that we'll soon try to bottom or at least end the bear trend and start to go sideways. Because of that, bulls will be willing to start to buy reversals up from new lows. This channel is really tight. This leg is strong enough down, so we'll probably get a second leg down. It's possible this is leg 1, pullback leg 2. Very tight channel. This is probably leg 1, pullback leg 2. In any case, traders will consider buying here using a wide stop and then buying more lower. For example, here is a second entry. Traders will buy more. If they buy here, they might buy more here. Or if they did not buy here, they'll start buying here. We're around a measured move down from the middle of this gap. Here's the breakout point. Here's that pullback, or simply a measured move down from the height of this bull reversal attempt. Whenever I see a bull reversal attempt like this, a buy climax, and the market comes down to its low, I think the market's trying to form a double bottom. Here, there's no obvious attempt to form a double bottom. However, I think of it as a theoretical attempt to form a double bottom. And if it comes down to this low and bottoms, this is the neckline, traders will look for a measured move up. If it comes down to this low and does not bottom at all and keeps going down, traders will look for a measured move down. Whenever you have a buy climax like that or a sell climax, you're always going to be looking for a measured move in either direction. Buy climax, the bulls will look for a measured move up. The bears will look for a measured move down. And therefore, this is support. And if the market gets near there and reverses, you know bulls will buy and bears will buy to take profits. Also 3 pushes down. We have an undershoot here, did not quite reach the channel. Strong enough bear breakout, so second leg down. 1 pull back, 2, a small double top bear flag, and then the second leg down. And very often when you get a strong breakout, that's all you get is 1 more push down, and then you get a reversal. I began by talking about how weak setups can sometimes lead to very strong reversals. A minor reversal can, in fact, lead to major trend reversal. Likewise, a strong setup can sometimes fail. And then it's very important to have a plan to take profits, because if you do not take them, they will disappear. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading major trend reversal bottoms.